This presentation will cover a recommended investment portfolio for a balanced wealth strategy. So our objective is to recommend an investment portfolio with £100,000 that will grow the money with limited risk and as much return as possible. Some of the priorities that we have are to open different asset classes. Client wants to understand risk and return trade-offs and to seek tax efficiency. This slide shows our recommended division into each asset group. On the left, we have the different classes. The next column along has the recommended split. Then we have what we expect to see from the investment. The next two columns have liquidity and the risk level. And then the final column is the expected rate of return per annum. To evaluate the risk and return characteristics of each investment, we use several key statistical tools. Standard deviation was used to measure the volatility of returns, showing how much an investment's value tends to fluctuate. The Sharpe ratio helped assess return relative to risk, showing how efficiently each asset generates returns for its level of volatility. We used a correlation matrix to understand how different assets move in relation to one another, guiding effective diversification. Lastly, we analysed historical versus forecasted returns to balance insights from past performance with expectations for future market behaviour. This table shows these statistical tools and their equivalent for each asset class. Standard deviation measures the average percentage deviation of returns from the mean. We worked out the Sharpe ratio using the formula. The correlation with equities, 1 is perfectly correlated, 0 would mean no relationship, and -1 would move the opposite. By combining assets with both low and high correlations, we reduce overall portfolio risk through diversification. Using the efficient frontier framework, we've optimized the asset mix to achieve the best possible return for a given level of risk. The portfolio targets to return of 5.5 to 6.5% per annum, with a volatility of 8 to 10%. This slide shows some of the tax implications in the UK. So equities and funds are subject to capital gains tax once the gains pass the annual allowance of £6,000 for this tax year. In addition, dividends are taxable above the £500 dividend allowance. Bonds, including government and corporate, don't benefit from capital gains tax exemptions. Any interest earned is taxed as income. Real estate is treated as either property income or dividends. Depending on the fund structure, these are taxed at your marginal income tax rate. Cash and money market funds generate interest income, which is taxed under the savings allowance. That's up to £1,000 tax-free for basic rate taxpayers. ISAs are incredibly tax efficient. You can invest up to £20,000 per year, and all income and capital gains inside the ISA are completely tax-free. Lastly, for longer term investing, pensions such as SIPPs offer tax relief on contributions up to your annual limit, and the funds grow tax-free until they're withdrawn.
Here is a basic visual representation of the portfolio. The efficient market hypothesis. This states that all public info is already reflected in asset prices. Implications of this include that it's hard to beat the market consistently, it favours passive investing such as index funds, and it highlights the importance of asset allocation over stock picking. Here is our investment summary and shows how the different asset classes have implications with the efficient market hypothesis and the recommended strategy as a result of this. First of all, UK equities. The market is informationally efficient, prices reflect all known data, and active stock picking is unlikely to outperform. Therefore, the recommended strategy is to use low-cost index funds, avoid timing or stock picking. Global equities. Implications. The global diversification aligns with the EMH. No consistent advantage is selecting regions or sectors. The recommended strategy is therefore to continue passive exposure via global ETF and focus on long-term diversification. Bonds. Implications include bond prices reflecting interest rate and credit risk information. It's difficult to gain excess returns by forecasting rates or defaults. The recommended strategy is therefore to use diversified bond funds, match duration/risk to your needs, and avoid timing strategies. Real estate. Publicly traded REITs behave like equities and reflect market information. There is no edge in selecting individual REITs. Invest in broad REITs and ETFs or diversified funds and use for income and diversification is therefore the recommended strategy. Cash or money market funds reflect current monetary policy and short-term rates. Low returns are expected and minimal pricing inefficiencies. Therefore, use for liquidity or capital preservation, not return generation. Alternative investments such as gold may be less efficient but still hard to predict. Gold and infrastructure are useful for diversification but not speculative returns. Therefore, use as a hedge or diversifier and avoid speculative trading or trying to time commodity cycles. The overall implications of the efficient market hypothesis. Passive over time. The hypothesis supports passive investing through index funds or ETFs. Diversification. There's a broad diversification across asset classes and geographies and is a rational response to market efficiency. Costs matter. With limited opportunity to beat the market, minimizing fees is critical to maximizing net returns. And finally, long-term horizon. The efficient market hypothesis aligns with long-term investment strategies rather than short-term speculation. To conclude, the diversified investment strategy aligns well with the efficient market hypothesis, favoring low-cost, passive investments across global equities, bonds, real estate, and alternatives such as gold. By avoiding active management and market timing, it aims to capture market returns efficiently while managing risk through broad asset allocation. Each asset class serves as a strategic role: equities for growth, bonds and cash for stability, and alternatives for diversification, ensuring a completely balanced exposure. The efficient market hypothesis supports this approach, suggesting that consistent outperformance is unlikely, and therefore disciplined, cost-effective investing is the key to long-term success. Thank you for listening.